It's hard. It's hard. I think making sure you stand for something different or you thoughtfully segment your own market and you help the investors think about segmentation is a very important thing to do. So, for example, with the AI interviewing market, like I said, you could say Mercor has just raised a $10 billion, for example, and they sell data labeling hiring to the foundational model companies. But then you could say, but data labelers are like 1/1,000,000th of the overall job market. Everybody hires. So they can build a business there. We can build a business here.
This is the 1 Point Podcast, and I'm Rohit Yadav. Welcome to this new streamlined format that is shorter, sharper, and more impactful. In each edition, I will spotlight either an insightful trend from the ecosystem or a thought-provoking perspective from a venture expert or a bold idea worth exploring further. And today I have Samit Kalra with me, whose post on Series A is the new Series B was quite intriguing and spoke directly to the new fundraising environment we are right now. Samit is a partner at 1984 Ventures, an SF-based pre-seed and seed fund. He spent 3 years at Bain Capital Ventures, and prior to that, he worked in sales and operations at AngelList. So, Samit, before we all start, tell us what is 1984.
Thanks for having me. 1984 Ventures. We are a pre-seed and seed fund based in SF, investing mainly in the US. We're investing out of our third fund at the moment. It's $70 million. So we typically write somewhere in the $500K to $2 million range. So we can lead smaller rounds. We can also be part of larger seed rounds. 3 broad focus areas. I would say vertical AI these days is a very important one for us. Digital health is also one. And then open source and infrastructure software is our third bucket. And we're a team of 4 partners, and we've been in operation now for about 7 years.
Wow. And what differentiates 1984 from the other VC funds out there?
Yeah, I think certainly stage. So we are pre-seed and seed focused. We're not a multi-stage fund. Our first check is never going to be at Series A. The sector focus as well is also pretty specific now. I think we started out to be a bit broader and have built up expertise in each of these areas of focus, and they're quite distinctive areas. And so, for example, within healthcare, our healthcare partner is a former healthcare founder. He's a part-time ER doctor still. He's really well connected within the US hospital scene and just brings a really unique network. Our open source partner, he's still an active engineer. He contributes to a bunch of open source repos and code bases and can see things that others don't because he's an active user. And then within B2B software, which is mainly where I invest, we now have a portfolio of, 30 plus B2B software companies, including ones that have hit $100 million of revenue. And so it's all that we look at. We've seen enough, we've made about 100 investments as a firm over the last 7 years. So we've seen quite a few stories play out. So yeah, I would say it's both those things, but like every fund, it's easy to say that you're different, but doing things well consistently is probably the most important thing. And so fund performance is what we strive to max out on.
Okay, awesome. And in your personal investment framework, that execution beats theoretical moats. Can you give us a couple of examples from the investments that you have done already or from your portfolio?
Yeah, this is a really evolved line of thinking for 2025 onwards. I would say when I first started venture, I think like many people was very attracted to frameworks and wanted to understand what a good looking company and investment looks like and what a backable founder look like. And I think it's very easy to default to analyzing the market and the information that's given to you. And now I think with having seen so many different stories play out, we've seen the slow growing company that's gone on to do really well. We've seen the fast growing company that's then slowed down. We've seen just the slow compounder that nobody cared about for many years that's now a really powerful force. So we've seen so many narratives play out, including multiple pivots, that it is a fool's errand to over-rotate and over-focus on the market dynamics and the exact business idea. So what that means is that the best thing to focus on is the founder. And everybody says that. It's a really annoying phrase, the founder's all that matters. I don't think it's all that matters. I think you need to pick a broadly good space, but the founder matters more than ever now because although AI has meant that you can invest in any sector, so that's a huge change. You can now invest in offline services industries. That was not a thing you could do 3 years ago, for example. So now you can build a business anywhere, but also the time to have a unique insight and to not have fast followers has shrunk drastically. So there's really no space where if you find a really great value proposition, others won't also flock to. And that time to fast follow is like weeks/months now. So you really can't expect that you find something that other people don't. And therefore, what that means is, how do you win? You win by being faster, so building software much faster, being more ambitious, so not just being satisfied with your first business line because others are also going to get to that. So you have to become multi-product very quickly. You win by being a better fundraiser because you want to be that chosen horse in a certain space and you want the biggest and best investors to support you that way around. And you win by having the biggest ambition as well. And so it really is like it's easier to start, it's harder to win. And
Okay.
so we think that execution, which is putting all those pieces together, matters more than ever.
Understood. Samit, can you also mention a couple of portfolio companies where you have seen this execution beats theoretical modes?
Yep. So a good example that comes to mind is a company of ours that just raised a Series A. Alex.com is its name. It's an AI interviewing tool. So even, we led the seed round in March 2024. And at that time, it was still science fiction to be interviewed by an AI. That's changed quite a bit in that time period now, and they were one of the first to market. And then I would say, in the last year, there's been a flood of other players coming into that space. But this company still was able to raise its Series A quite recently from a top tier investor. And despite the competition, I think the execution that came through with this business was they had, in a short period of time, been able to work with some really top tier employer logos. So, names that are just like household names. And that I think is a signal that why did those large enterprises pick working with a seed stage company? That's a signal. The second is the quality of the hires that the founder was able to make in that time period, which is if you've been investing for long enough, you can see, hey, in 1 year's time, this founder has hired 5 really strong people. In 1 year's time, many other founders have barely hired anybody, and so like those relativist signals also come through. And then the third thing is just the founder's clarity of thought. And so there's a lot of interesting recruiting tech businesses to be built now, even though that wasn't the case a few years ago. And so you could build one servicing startups. You could build one servicing high volume staffing. You could build one servicing large employers. You could build one servicing data labeling hiring, like many companies are right now. Explaining why you're going after one and why it's a lucrative opportunity and being persuasive about that also signals clarity of thought, which when coupled with team building and, impressive logos, I think really is what it takes to get investors excited about somebody winning. And so execution is just kind of all these positive signals combined that gives people confidence that you are a winner.
Got it. So let's move to the main topic of the podcast, which is the Series A. And you wrote a couple of articles. Let's capture the first one, which is the Series A deck strategy. So map for us all the main points and the top 3 must-haves which a startup should have in a deck.
So we, as one of our main value adds as a seed fund is making sure that you raise your next round, Series A typically. And I think we have about a 75% success rate over the last 7 years. So it's something that we focus a lot on. And part of that is getting the deck right. And I think the Series A bar has gone up. So getting this deck right matters even more. And now we've seen lots of companies do this well, and lots of companies do it poorly. I ended up writing this post pretty recently on this area. And so the first thing that I think founders get wrong is they just bombard information in this pitch deck. You know, investors are getting tens of decks every day, I would say, and quite it's quite hard to pass through and figure out which companies you should meet with. You know, there's many ones that you shouldn't meet with. That's quite obvious. There's a few that you should obviously meet with, but that's very easy. And there's many that are like, should I bother spending time on this one? And most companies fit within that area. And so the first thing is that you don't want to overwhelm the investor before and make them not want to learn more. And so founders typically write these like management consulting style McKinsey decks, which is facts on every slide. And it's just, if you've never heard about the space before, how are you going to learn 15 things on each slide? You just want to learn something cohesive that's interesting that makes you want to take the meeting. That's the purpose of the pitch deck. And so the first message that's really important, it sounds very simple, is one idea on each slide, not three, just one. And typically the idea should just be in the slide. And so if someone just flicks through the slides and just reads the first sentence, will that story make sense to them? Will it interest them? And will they want to learn more? I think that's a basic thing that all founders can do. I would say the second thing is the slide deck shouldn't be more than 15 slides long. Many people are like, hey, let me jam all this information in the back. Like, once again, the purpose of the deck is just to get the investor to take that first meeting. And then after that first meeting, when they, force them to want to learn more, that's when you start to share further thoughts. So I'd say slide deck length is also very important. And then the third thing is just like narrative. Narrative has to be interesting. They have to be, everybody's looking for home run hits here. They're not looking for safe ideas. And that can be quite a complicated thing to convey as a founder, because you want to also convey that you've de-risked what you've built, but you want to have a story that attracts someone to think that if this thing works, this could be really big. There's many, many more things that you should include in your pitch deck or not include in your pitch deck, but those are the top three ideas that if you just structure a deck with those in mind, it should hopefully add some clarity about what to add and what to take out.
Okay. I mean, it's intriguing, right? So a lot of those aspects with respect to a deck remains the same, whether you are doing for seed or probably for Series A and so on. So if you have to differentiate between what specifically is needed for a Series A deck versus what you see in a seed deck, or what those things would be.
I would say the main differences would be the bar for Series A is very high. So you want to capture interest right up front. So the best way to do that, if you have amazing traction, put that as slide one, boom, up into the right graph. Like, okay, now the investor's going to say, let me now pay, interest over the rest of this deck. If you haven't got that, it has to be something else. It could be that your team is really stacked and people should say, let me wow, these set of folks are working on something together. Let me learn more. If you haven't got that, then it should be a really interesting story, like a really unexpected insight about a market that was otherwise ugly that's now interesting. We invest in a company in the debt collection space. Debt collection is a very ugly market, but actually really well suited to being upended by AI. You wouldn't think that unless the person explains it to you. And then once they do, you're like, okay, that makes sense. So similarly, I would say that would be the third best thing to do, but you need to capture interest right up front. That's the first thing. The second thing is that in a seed deck, you probably don't need to talk about product roadmap as much. But for a Series A, now that, AI is making software building so easy that if you have one initial wedge product that's working, it's great. But like I said, others are going to come in and also see that and also mimic that. So you need something more. And the product roadmap shows that this company is not just resting on their laurels of business line one. They've got a really interesting, ambitious vision. And on that roadmap idea, I think becoming a system of record is a very interesting idea. There are certain phrases that investors like to hear, like, within healthcare, it's a business in a box is a very interesting phrase that investors get, intrigued by. There's been many nice companies doing that over the last few years. I'd say, yeah, system of record is one now as well, because you can actually build something. You can build a much more fulsome product much more easily now with these AI code gen tools. So having a roadmap that shows that there's something valuable that you're building, it also signifies the founder's ambition. Anything else that's worth including in a Series A deck that's different? I think the third thing would be that, like I mentioned, competition is rife in every space. Having a very thoughtful segmentation on why you are different would be the other important thing, versus you might not need to say that at seed, which is just more about a bet on this team and this broadly interesting space.
So, moving to your second article, which highlighted the tougher fundraising reality of 2025, which is, I would say, tough for everybody in this sense, except for if you're in the top league of AI. So you call Series A is equal to the new Series B, and you mentioned that today's Series E expectations mirror what was previously the Series B. So what would your advice be to founders who are stuck in the middle, are complacent with respect to expectations, and what would a now standard series demand would look like?
Yeah. And so we get asked this question a lot of like, what revenue should I be at? And unfortunately, there's never an answer that there's never one answer. But what is clear is that the bar is way higher right now. So like, it's just, I think founders should get that in their head that like, this is not like it was 3 years ago. This is a different world. And it's a much more haves and have not world, where the haves will get funded and overfunded. A Series A and a Series B and a Series C can happen within the same year. And then everybody else is kind of getting shunted. And so I think the revenue, it used to be that, like, broadly speaking, if you get to $1 million of top line, you're in a good spot to go out for a Series A. I would say it's a dangerous number right now, especially if there are other players in your space also doing well. And that's the reason why it's dangerous is because it used to be the case that there was, 2 or 3 good companies come Series A in a certain space. So investors could meet all of them and say, hey, this is my favorite, and I can explain to my partners why this one's better than the others. Now there could be 10 doing well. And so investors are not good at picking between 10. And they don't often have if you don't have the clout internally to explain why you picked company one and not, any other player, you're probably fearful of making the wrong call, especially if it's a space that you definitely want to make a play in. So you might then choose to wait for Series B. And so this is why having a rock solid pitch come Series A matters more than ever. That might be like unbelievable growth. That might be a really unique vision or like tack on this market. Like, yes, we're all starting with the same thing, but I'm going here and others are going here. And so if you're at $1 million of revenue in a space with a bunch of other players and you've gotten there relatively quickly, I would probably advise you to consider raising what is called a seed, but it could be a small Series A. And so many funds are now playing in this sliver of the market.
Okay.
There's a bunch of larger seed funds that are writing $5 million checks upwards. Obviously, Series A funds also invest at seed, so you can also pitch them. And if they get interested, they can flex their check up from 5 to 7 to 9 to 10. Like, these numbers can like easily increase if they're interested. And so my advice would be for founders to pitch, to call it a seed, to pitch both seed and Series A investors, to aim for a larger seed. And if you are so lucky to get multiple offers, that can very quickly turn a round size, from 5 to 7, 8, 9, 10.
You used a word which you termed as jumbo seed. What does that mean?
Jumbo seed is this probably $5 to $9 million round, I would say, which, it used to be that Series A's were like $7 to $10 million in the past. Now it's more like, call it 15, 20. And so jumbo seed is kind of what was the previous Series A round size. And so, yeah, pitch those seed funds that are like $200 million funds. There's a handful of them out there. Pitch the new class of funds that are being born right now to play in that the old Series A area. And there's a few that I mentioned in my article as well. And then pitch the multi-stage funds too.
Yeah, you actually mentioned quite interesting points. With respect to revenue, there is no one kind of revenue which is acceptable. I read recently a Bessemer study, and they did a benchmark comparison of AI startups, calling them supernovas versus shooting stars. It's making waves on internet right now, where they say like supernovas in year one they reach up to even 40 million ARR versus the shooting stars, which they gave other parameters. So we can see, there's a lot of push towards these AI companies which are producing a lot of high ARR. Do you have some other pointers for founders who are thinking of raising their Series A?
Yeah, I would say ignore articles like that, firstly. Like $40 million of revenue in 1 year. Well, firstly, in many cases, it's been less than 1 year that those businesses have even been, you know, around for. And so there's no signal on churn. There's often very poor gross margins. Like, we're in the bubble period right now where there are companies that have found explosive customer love, but have very questionable business models. Investors are still very excited about those businesses, but it doesn't mean that those businesses long term become good businesses, right? And like I mentioned, we've seen 100 plus companies now over the last 7 years. It's not just about the fastest growing company that is the one that does best. And actually, I think Reid Hoffman posted this thing recently as well, that like he's been investing for many, many years. It's in his experience, it's not just about the fast growing companies either. So don't be overly scared and freaked out by these metrics, because these are 1 in 1,000, growth rates. This is very abnormal. In saying that, the growth rate expectations have gone up a lot because of this. So you can't be anemically growing and expect interest anymore. That is certainly changed. So something needs to be working. But I think there are many investors who realize that a company that goes 0 to 1 or 0 to 3 or 1 to 2.5, like, there's enough signal there that they can go and speak to customers if they find the space interesting. And there's market pull in all those cases. So you might not be the fastest ever, but like you certainly have to be fast. But not every investor is totally obsessed with vertical kind of growth rates. Multi-stage funds might be a bit more like that these days. So once again, a good reason to pitch a broader swath of investors. And that's, by the way, the expectation for a founder should be to meet 40 funds come Series A, not 10.
You mentioned this before about competition. Previously, it used to be one or two companies. Now, at least there are like 5 to 10 strong players in many categories. How would you suggest the founders to stand out at the Series A fundraising?
It's hard. It's hard. I think making sure you stand for something different, or you thoughtfully segment your own market and you help the investors think about segmentation, is a very important thing to do. So, for example, with the AI interviewing market, like I said, you could say Mercor has just raised $10 billion, for example, and they sell data labeling hiring to the foundational model companies. But then you could say, but data labelers are like 1/1,000,000th of the overall job market. Everybody hires. So they can build a business there. We can build a business here. Similarly, they can be a business built for high volume stuff, restaurants, like there's many ways you could segment a market and find compelling markets that are all worthy of new large players. So I think it's incumbent on founders to help investors break down a market, especially as markets have changed so much recently. Like I mentioned, offline industries are now places to invest. people would say not every investor has updated the way that they think about that. So, for example, we have a really fast growing company in the automotive space. They sell to, you know, um, like auto shops and body shops. And that's a segment that historically, you would think those people don't really buy software. But if your pitch to them is our software makes your business more money, doesn't really matter what industry people are in, they eyes get pretty lit up by that idea. So this business has done really well selling into auto shops, and that's a space that investors didn't care about until they met a company growing really fast, and they said, okay, now let me learn more about it. So founders need to educate investors on why their space is interesting and why what they're doing is different to what others are doing. And that's contrary to advice that people may have given about competition doesn't matter, it's just about customers. I think in this market, explaining why you're different is part of what it takes to convince investors.
Got it. Uh, Last question from my side. Your personal take. There are a lot of thoughts and insights on the internet now these days. I mean, you wrote the articles on Series A, is the kind of new Series B, and so on. How frequently do you see that the portfolio company founders are prepared, or rather, I would say unprepared, despite all that knowledge which is out there? And what do the founders often overlook?
They're mostly unprepared, I would say, unless there's second time founders that have been through it before. It takes quite a bit of preparation to produce the right deck, the right data room, and the right story. And many founders dismiss that and think that they can just put together a few slides and get get going, or like they can have a few, coffee chats with investors that reach out, and it's never a casual chat when you're speaking to an investor. I think that's another piece of advice. I think founders should expect it takes about a month's worth of prep time with their seed stage lead investor to find the right story, to do a couple of turns on that pitch deck, to practice the pitch, and then to get a bunch of warm intros to Series A leads. And then it probably takes a month at a minimum of meeting investors to close that round. It can take more like 2 months. And so they should make sure that when they are fundraising, they have cleared the decks for time to be probably at least 1 month's worth of time where their ongoing responsibilities are handed off to someone else. And they should really invest the time and effort in the lead up to that fundraise to give themselves. Obviously, founders are super busy people. This is not easy to find that time. But this is not something you can half-ass, and if you do, you will it's just so hard to raise right now that you might as well give it your best shot, and that shot significant time and effort to do it right.
Okay, awesome. Samit, thank you so much for joining us and sharing your insights over this crucial topic. I mean, a lot of fun founders are fundraising right now, and probably they are missing some portions of what you already mentioned. So thank you so much for covering all those insights. Thanks.
All right, thanks for having me.